Welcome everyone to our 2022 Department of Revenue Tax Bar Liaison meeting. I am Richard Litwin, moderator from the Atlanta Bar Association Tax Section. Will the other moderators please introduce themselves?
This is Frank O'Connell. I'm the interim commissioner at the Georgia Department of Revenue.
Hello, everyone. This is Mace Gunner. I'm representing the Georgia State Bar Tax Section.
Thank you both. A few housekeeping matters. First, thanks to Lane Sosby, Mary Jo Sullivan at the State Bar, and thanks to Karen English at the Atlanta Bar for their help in coordinating this event. Special thanks to Lane Sosby for facilitating the Zoom conference. Please, attendees, keep your screens muted and your audio muted, excuse me. For CLE, today's event is free to attendees. We are getting 2 hours of CLE credit. We were unable to get the additional half hour of credit, but the CLE has been approved. So you're getting the CLE. Thanks to Mace Gunner for his hard work in getting the presentation approved by the State Bar of Georgia. Again, no further action is required for you to get CLE credit. It has already been approved. Also, you should have your materials. Lane Sosby emailed them to you this morning. Please refer to them during the presentations. Finally, please use the chat box at the bottom of the screen to submit a question. Thanks to Commissioner O'Connell for your support of these liaison meetings. We couldn't do these without your support. Thanks also to the folks who participated: Kelsey Finn, Jarder Gal, Ann Whipple, Charles Elrod, Ron Stay. They all prepared presentations and are either presenting today. Finally, just of note, Robin Crittenden, the former Commissioner of Revenue, left state government on November 25. So Frank O'Connell is the interim State Revenue Commissioner. And with that, I'm going to turn it over to Commissioner O'Connell to give us a little bit of an update on the department's goals and issues for 2023 legislation.
Thank you, Richard. Just a little bit of history. When I first came to the department in 2003, the department had pretty ambitious legislative agendas. And I'm talking about legislative amendments or new bills that we would seek on the department's behalf. Probably the most significant was in 2005 when we had the State and Local Tax Act of 2005. And I think it had probably around 16 different code sections that were amended when it passed. And so those included items that were administrative. For example, I think it was in that bill where instead of having a non-resident S corporation member consent every year, we would just get one consent, and then whoever stayed in the S corporation membership would not have to get another consent. Reduce the penalty for non-resident withholding from 100% to 25%. Because the truth was, we rarely imposed the 100% on top of the 100% of tax that was due. So the 25% was a lot more fair. Now, there were substantive things in there, because I think that bill included an addition to the Nexus statute, adding deriving income from sources within the state, in addition to doing business in Georgia. So that was a substantive addition there. And there were some substantive policy type things suggested by the department. Over the last decade, 10, 12 years, our agenda has been much more streamlined. And I think that's appropriate. We pursue things that we would like to have to make administration of the tax system easier. And so in the past, perhaps we'd have a dozen items. It's been more typical in recent years to have about 4 items. As an example, this year, we will pursue the Internal Revenue Code annual update, where we check and see what has the um, the legislature passed at the federal level over the prior year, and we do breakdowns. The Fiscal Research Center assigns costs, and the legislators determine what do we want to conform to and what do we not want to conform to. So that bill is an every year thing. Apart from that, there's just a couple of small administrative items. And in fact, this year, the couple of items beyond the IRC update are a couple of things in the motor vehicle area, one of which would prevent someone from taking advantage of language. To my knowledge, no one has so far, but in the early stage when you're getting a new title, there's something that could have been interpreted that perhaps you could get a title and register and not get the insurance. I think we could make arguments, but it wasn't clear enough. So we're going to make a request of clarification to nail that down. Obviously not hugely significant. So what we end up doing is we kind of call it playing defense, but there are close to 200 bills dropped every year in the General Assembly. Probably 140 or so are tax-related bills, and the other 60 or so are in our areas of alcohol and tobacco regulation, motor vehicle tag and title. We also have something to do with the real estate transfer tax and a couple of other miscellaneous items. And so when the bills are dropped, we will have folks in those subject matter areas take a look and see how they can affect the department. Sometimes legislators or even lobbyists will reach out to us to see what we think about legislation. And in the past, we've worked together with groups like the CPA Society. Years ago, there were bills to put in more penalties, similar to some that the IRS has. And we went downtown and met with a group that included CPAs, attorneys, et cetera, and did it in a spirit of cooperation. And I think you end up in a good place when you do that. So we don't have a significant agenda. We are prepared for a significant agenda. At times in the past, we've said, oh, we think it'll be a light year. And in my 19 years at the department, we have not had a light year. There's a number of credits that I think may be looked at this year in Senate Bill 6, which was passed a couple sessions ago. A number of credits were listed, and let me see here. Okay, including the high-tech sales tax exemption, the computer exemption, jobs credits, probably 10 or so different items have been chosen because the bill gave legislators the right to choose sales tax exemptions or income tax credits to get studies performed. The deadline was December 1st, which passed just this past week. And so the department has been busy providing information pursuant to a lot of data requests that we've gotten in these exemption and credit areas. So I have no doubt that there will be changes in one or more of those credits. It's good as a citizen of Georgia that the credits and exemptions are being looked into. Perhaps about 15 years ago, I remember talking to one of the fiscal note assistants. It was at a time when we were getting new systems, and I was concerned that our systems were up to speed in terms of getting the information that legislators would want to have to analyze credits and whether or not they'd been doing what they were intended to do. The response of that person at the time was, well, there's really no need worrying about that. The legislators are more concerned in passing the credits and not analyzing the credits. I don't think that was true, but that was something that was not looked into by a lot of states, but that has really changed over the past decade, particularly the last 5 years. And now Georgia is no exception. And we do have what we call a business credit manager, and we produce monthly reports and provide them to the governor's office and the legislators, and they can see exactly what credits have been claimed, the numbers that have been applied to reduce tax liability, and then the number of carry forwards. And those are not insignificant numbers. As an example, I think the film credit, there may currently be $1.5 to $2 million of outstanding credits. Obviously, if you're planning the state's fiscal future, or your legislators looking at credits and their effect on the state, you're going to want to know significant things like that. So fortunately, today we can provide that information. Any questions?
Frank, you think that this year you don't anticipate a lot other than a review of the credits. You said from Senate Bill 6, and you're talking about or the exemptions. I'm assuming there's exemptions in there too, right?
Yes, like the high-tech
high-tech exemption.
Yeah.
All right. And when the session starts in general, how soon after a bill is dropped do you all get it so that you can check it out and make sure, audition it or whatever you need to do to make sure that it's in line with policy, that you're trying to implement there?
Obviously it varies, but we encourage legislators to reach out to us as soon as possible. Sometimes it may be the same day it's dropped. Other times it may be a week or so later. Now, a lot of committee chairmanships have changed this session. And so one thing I'll do is try to meet all the committee chairs and let them know we're here, we're a resource to you, and please reach out to us if you get a bill in our area, because the worst thing to happen is to have a bill, and there have been times where we've suggested changes, and for whatever reason, who knows, it might be day 39 or 40 and time ran out, but there were changes that we had advocated because we knew that the sponsors wanted the bill to do a certain thing, and we felt that needed to read a little bit differently in order to do that.
Right.
So we are heavily involved. We have a legislative liaison whose primary responsibility is working with the legislature. Our prior one left us about 6 weeks ago, Mason Rainey, who did an excellent job, and coming to us within the next 10 days is a gentleman by the name of Austin Gibbons. He'll be our new legislative liaison. And we have the advantage of Austin having worked in the governor's office the last couple of years. He has been one of our main contacts with the governor's office and the General Assembly. So we're in very good shape as far as, a lot of it's about relationship and communications. So I think good shape.
Well, great. I think unless you have anything else, that will wrap up this portion, and we'll move on to the next portion. Before I do, somebody said, do we need to do anything else? Or somebody has asked the question in the chat, do we need to do anything else for CLE purposes? And the answer is no. CLE has been approved. You've gotten a CLE. There's no other steps you need to take. So now we'll turn to Commissioner O'Connell to tell us about the reorganization of the Office of Tax Policy and the new Office of General Counsel. So maybe take 25, 30 minutes to talk to us about that.
Okay. You mentioned Commissioner Crittenden. She was appointed by the governor July 1st, 17 months ago. So July 1st, 2021. And when she came on board, reorganized the top leadership of the department to an extent. We still have our 15 or so divisions, compliance, audits, motor vehicle, tag and title, and the like. But our top structure was commissioner, deputy commissioner, who was me, and then I had 4 reports: the general counsel, the office of general counsel, the assistant deputy commissioner for tax operations, Chester Cook, and that included compliance. It included collections of past due liabilities, audits, taxpayer services, and then assistant deputy commissioner for external operations included our law enforcement efforts in alcohol and tobacco in the Office of Special Investigations, as well as the motor vehicle division and local government services, which includes property tax. So we had commissioner, deputy commissioner, 3 assistant deputy commissioners, and the general counsel. Today, I have no intention of changing that structure. As interim, I'm not going to make any significant decisions like that. So things will stay in place. So currently there's me as interim commissioner, me as deputy commissioner, me as general counsel, being a little bit facetious, but a lot of things report to me right now directly. But as soon as we get the final word from the governor's office, obviously there'll be some additional changes. Currently,
And when you say word from the governor's office, what are you referring to about?
Whether or not, who the permanent commissioner will be. Yeah. So.
Do you know about when that decision is going to be made?
I really don't. So we'll see. I'm prepared either way.
Okay, good.
So before I get to today's structure, just a little history of what I think is on the agenda is legal affairs and tax policy. The group was instituted in 2004. It was one of the suggestions of a white paper done by one of the big 4. And they had noticed that we had people performing similar functions, but everybody was with their tax type. And so they suggested moving the functions together and grouping by function. And so the first precursor of the current LATP was called Tax Law and Policy. The first director was a woman named Laura Butler, and I'd worked with her at Ernst & Young. I had actually come to the department probably a year and a half before she did. Of course, I used to negotiate with the department, and the gentleman was retiring. He knew I was interested in public service, and his name was John. He offered to let me know when his job was being interviewed for. I interviewed. He could have been a little bit more fair in some of the questions they asked. Who knows about trial court decisions on state and local tax? But despite messing up a couple of those questions, I succeeded in becoming the supervisor of corporate income tax audits, which was a great introduction to the department for a couple of years. Now, in the initial goings, Tax Law and Policy had conferees, and the conferees would hear tax protests from audits or other divisions. They would draft rules and regulations, and I suppose they would prepare the legislative agenda back then. And so there were no attorneys in the old TLP. When Laura Butler came on board as the first director of Tax Law and Policy, she politicked the commissioner, Bart Graham, and the deputy commissioner, Ed Maney, for me to move and become her assistant director. Ed said, yes, but first you have to find me a replacement for Frank. And so for about a year, she tried to find someone to step in my shoes. Wasn't initially successful, but they let me move into the role anyway.
I'm
so
sorry. I'm sorry. Let me interrupt you. This
yeah,
is very interesting to history. When you say John, I'm thinking of the guy whose father worked for Coca-Cola, and I can't think of his last name.
now was that Mike
No,
O'Brien?
Michael Bryan. So who's the John you're referring to?
John Wells?
John Wells. Okay, sorry. Yeah.
Yeah, those are the Wild
Okay.
Wells West days.
Yeah.
Um, so
So they couldn't find a replacement for you, but you moved to the position anyway.
yes, as an assistant director. Um, and again, we were focused on policy matters, and our council, is the Attorney General's office, just as they are today. But over time, we hired a couple of additional attorneys in the group, some who had some contracts background, and there would be contract questions that would be handled by tax law and policy, and other legal things would tend to come to that group because we did have a couple of attorneys in the group. And at a certain point, I asked Commissioner Doug McGinnity, since people would ask other divisions, who are your legal folks? And they would refer them to tax law and policy. I asked them if we could change our name to Legal Affairs and Tax Policy, and we did so, and formally adopted a legal presence. I remember working with Warren Calvert at the time, and he was our deputy, assistant deputy,
Senior Assistant Attorney General.
senior assistant attorney general. Thank you, Richard, who ran the tax group. Wonderful, wonderful gentleman. He has been retired for, I'd say, about 8 years, but had lunch with him about 3 months ago. Wonderful guy.
Oh, great.
And he's doing well, by the way.
Okay.
And I told Warren that we were going to kind of formalize the legal structure at the department, and just wanted his input on what we would call ourselves. And he said, please don't call yourselves counsel. And the reason for that is in the statutes, the Attorney General is the counsel for the department, and has to represent us in court, is the body that is authorized to say what the law is. And so even though we were performing, some legal interpretations to a certain level, he didn't want there to be any confusion. And so I became director of legal affairs and tax policy, and my assistant in that area became deputy commissioner for legal affairs. Over time, Lynn Riley became commissioner, and she asked me to take the title of general counsel. The first thing I did was call the Attorney General and let Warren know that I'd been asked to have my title change. And within a couple minutes, my phone rang, and his boss said, "Hello, Mr. General Counsel, how are you?" So news got around fast. But I have to say, we have an excellent relationship with the Attorney General's office. I don't think it could be any better. There's a lot of mutual respect. One time, the legislature found out that we had probably at the time 8 to 10 attorneys, and they thought, well, if you've got attorneys, those are supposed to be at the Attorney General's office. And so there was a proposal to probably cut our budget in half. And I think they were thinking about moving those attorneys to the AG's office.
Wow.
Yeah, huge potential change. But Warren worked with me because the quasi-legal stuff and legal stuff we did was different.
Yeah.
And frankly, they didn't want to do the stuff we did.
Right.
And so we laid it out there and sent a letter to the appropriate places, and they did not make that move, which is good.
Good.
If you, and it's funny too, at the time, to try to take a little bit of the spotlight off of us, we took legal out of the name for a period of time. So we've had about 4 names
Policy, right,
since I've been there.
right.
And now if you fast forward to current, the commissioner looked at the structure of the department, and in particular of legal affairs and tax policy, and suggested that, you know, there are roles there that we might be better served by differentiating. You know, as we all know, it's not easy. You've got tax experts who are attorneys and CPAs and attorneys and CPAs, not to mention enrolled agents. All sorts of people assist others in tax matters.
Even people who aren't attorneys and aren't accountants, they try to do it.
Exactly. And so it has its challenges, because obviously either way you're working with the tax law. But in the Office of Tax Policy, which is one of the 2 groups we are now split into, there's not a requirement to hold any of those positions free to be an attorney. And I think partly she wanted to ensure that for significant decisions, legislation that we might pursue, rules and regulations, she wanted to ensure that there was a legal review as well as a review by a subject matter expert in income tax, sales tax, whatever the case may be. And so we did split. And so currently in the Office of Tax Policy, there's an income tax policy group directed by Kelsey Finn. And when her presentation is presented, you'll find out who the 5 individuals are in that area. There's also the sales tax policy group. Amy Oneacre is the director of that group. And they've got 4 positions in that group. They also have the Georgia Tax Tribunal group, which is 3 folks that assist in working cases that have been filed in the tax tribunal. At one time before the split, there were 4 groups: income tax, sales tax. Then there was a group that was sort of quintessentially legal, which was contracts, open records requests, confidentiality issues, things that really were pure legal.
And when you say contracts, Frank, you're referring to just if the department had a contract with a third-party vendor or something like that?
Yes.
Okay.
Of which we've got hundreds. So there's a lot of work there. And then a 4th group, which had a few different names. At one time we called it miscellaneous taxes, but that doesn't sound very complimentary. So I think we ended up calling it the specialized taxes group. And that consisted of attorneys and others who gave advice to motor vehicle tag and title, property tax, and the alcohol and tobacco regulation, and the OSI agents.
Office of Special Investigations.
Yes, that's right. And so when we made the split, we brought the advisors for motor vehicle tag and title, property tax, and alcohol and tobacco licensing and regulation into the Office of General Counsel. And so the same folks that handled that before are now handling it in OGC.
Okay, so they're not in tax policy.
They're not, and the thinking was that a lot of what was the advice that was given in those areas was not necessarily tax driven. A lot of it was procedural in their statutes.
Okay.
The motor vehicle tag and title, for example.
Right.
You know, alcohol licensing and regulation. So that's where we drew the dividing line. You could have probably drawn it in a different place. So now on the OGC side, there are 4 groups, and one. Go ahead.
OTC.
Oh,
Office of Tax.
Office of General Counsel.
Office of General Counsel.
Yeah.
OGC.
And in those 4 groups, one is the contracts and compliance group. So that is basically what it was before. And then we have the Alcohol Hearing Office Group, which also provides advice to Human Resources. And then we have what was the Miscellaneous Taxes Group, and they're still providing the advice they did to motor vehicle tech and title, alcohol, and OSI, Special Investigations. Now we have a fourth group, which is the newest, and that is a position held by Charles Elrod. That is the person designated to give counsel to income and sales tax policy, and also to the compliance division when they do collections work. And hopefully, as of this week, the tax tribunal group will move from the Office of Tax Policy to the Office of General Counsel, where it makes sense to have it there. And so they'll report to Charles Elrod.
Okay. And so Charles is going to be wearing a lot of hats, basically giving advice. Will Charles Elrod be giving advice to any line agent who calls up and says, you know, I'm down here in Albany and I'm getting ready to padlock a bar or a hotel, you know, can I do it at 4 o'clock on a Friday afternoon? Is that going to be what he's going to be doing? Or is he going to be just dealing with the folks in Office of Tax Policy?
You know, I think Merrill Jacobson will probably get that call first.
Okay. All right.
Who he'll be with us a couple more years. And he's one of the few attorneys that's probably the only attorney that's not in the Office of General Counsel. But there's no reason to, you know, upset something that's worked well.
Right.
But whatever advice Merrill gave will come under Charles. And in fact, Merrill will confer with Charles. So somebody could call either one of them Friday at 4 p.m. and say, can we do this? So.
What else? Anything else regarding the change? You're all still on 15, the 15th floor, so that hasn't changed.
No. You know, at first it seemed like there might be some duplication. You know, for example, there are still attorneys and good attorneys in sales tax policy, and Whipple, for example. And so if they resolve a protest, if they want to confer with Office of General Counsel, you know, Charles will be their contact and their internal counsel for that.
So having said that prompts a question, I guess, or begs the question: if somebody in sales tax or income tax resolves a protest and has drafted a determination, will it be a requirement for that person in Office of Tax Policy to run it by Office of General Counsel first and get the Office of General Counsel's approval first before issuing it to the taxpayer?
You know, excellent question. And, you know, why set this all up if you're not going to have those consistencies, which you can only get by, you know, having involvement. Now, you know, are things going to take a little bit longer? Perhaps, but not much, because our agreements don't differ that, you know, tremendously from, you know, taxpayer to taxpayer. But I think you need to do that for a couple of reasons. One thing I hadn't mentioned was that income tax policy and sales tax policy now report up to the Assistant Deputy Commissioner for Tax Operations, Chester Cook, who's also over compliance and audit. And so, you know, we want to have consistency in the way we treat taxpayers, obviously. And the only way to do that is anytime we have any type of written settlement agreement with the taxpayer, is to have it vetted in a central location. And that person will be Charles for income and sales tax in the Office of General Counsel. And so that is a requirement in our executive orders. So very good question.
I'm sorry, go ahead.
Well, I was just going to give an example from, you know, the old days. I remember telling Commissioner McGinnity one time that the then tax law and policy had a certain position on an issue but our audits had a slightly different position. Well, he was smart enough to immediately call a meeting, realizing that we couldn't have two different positions on the same issue. Not that we weren't going to resolve that, because you can't treat taxpayers differently. But what I was alerting him to was there was a difference of opinion. When that happens, you try to work it out. At the end of the day, it's the commissioner's call, and you get together. But we have to make sure that we've got consistent positions being taken, because assessments are being resolved in audits, cases are being resolved in compliance, taxpayer services, the Office of Special Investigations, in some individual income tax assessments. We've got to be consistent. And the only way to do that is to have some vetting, however long you take to do it. And like I said, I don't think it'll slow the trains down, as somebody said.
Will your office also review revenue, I don't know, bulletins, let's say, that one of the policy groups is gonna put out?
Yes.
And I assume proposed regulations or draft regulations as well.
Yes.
Okay, good. And that makes sense. And I assume that, this has happened over the past year with this change. I've noticed it. I've just seen the different titles. Who heads the Office of Special Investigations now?
Jim Beveridge.
And are they still going to, I don't know, how staffed up are they?
Well, in terms of tax, they have a group. We have the fraud management system, which is another component of our integrated tax system. Every return is run through that to see if there's anything out of the ordinary in terms of addresses, thresholds, you name it. It checks for a lot of things.
Right.
So no refund goes out until it goes through the fraud management system. But they'll pick out certain returns for additional scrutiny, and there are tax examiners in OSI who do that, and they will issue some assessments.
Right. Are you able to talk maybe a few minutes about the anti-commandeering issues that are going on?
If you will enlighten me a bit, because I haven't had to deal with that issue.
Well, just with it's going on across the country with, the first thought is pirates, but it's my understanding that under these anti-commandeering laws, the old rule that the federal doctrine or federal law was supreme is now being kind of pushed aside, and the states are going to have more control over things. It's not necessarily something we need to address if you're not dealing with it now. It was some things that I've heard in the past few months that's going on across the country. Just a little, squatter about or talk and discussion about that. It sounds like, I'm sorry.
No, go ahead, Richard.
No, it sounds like you have things pretty much in place. I mean, and there's still in the policy group, there's still the credits section, or somebody who handles credits, right?
Yes.
And somebody, I guess, it's corporate income tax and individual income tax as part of the income tax group. Okay.
Yes.
Then I think that unless anybody has any questions, I think that's a good kind of overview of sort of the structure of the Department of Revenue and the changes that have been made over the past year, and hopefully changes for the better. I think we all in the bar welcome that. So let's move on just a few minutes early. Thank you very much, Commissioner.
Yes, sir.
For very informative. And let's move on to Jarder Gal, who will give us an update on income tax issues.
Thank you, Richard. Hi, everyone. So I'm filling in for Kelsey Finn today. She was unable to make it today because she was sick, but I'll go ahead and present all the income tax changes that occurred this past year. I'll go ahead and share my screen. And a lot of you should have already received this presentation via email. Hang on, I'm trying to get the PowerPoint up. Okay, so first off for the agenda, we will make an introduction of the income tax group of the Office of Tax Policy. Frank mentioned that there's two groups, Office of General Counsel and the Office of Tax Policy. I work specifically in the income tax group, and I'll introduce all 5 team members. We'll also cover the legislation that was passed this past legislative session, and also the regulations that the agency has promulgated and the policy bulletins that were issued. So in the income tax policy team, we have Kelsey Finn, the director, me as the staff attorney. We also have Cecil Felder, who's the income tax senior manager, Gary Truitt, who's the tax policy analyst, and Maxine Hodges, who's the paralegal. Some of you may have already dealt with either one of us regarding income tax issues. And for the 2022 legislation, I'm going to be covering very briefly the 14 pieces of legislation that was passed. And they are the following: House Bill 275, the increase to the living organ donor deductible amounts; House Bill 424 regarding the qualified foster child donation credit; House Bill 469, changes to the historic rehab credit; House Bill 517 regarding the qualified education expense credit, also known as the credit for donations made to student scholarship organizations; House Bill 586, there was an extension to the conservation tax credit; House Bill 1041, there were also changes to the qualified rural hospital expense credit. Also, House Bill 1044 allows counties to create what's called a regional industrial development authority, and it also modified some rules regarding the quality jobs tax credit. Finally, on this last 7, House Bill 1058 regarding consolidated income tax returns. Now, starting in 2023, you can make the election to file consolidated on your tax return instead of applying for pre-approval from the commissioner. House Bill 1064 is a new exclusion regarding military retirement income. House Bill 1302 is what's also known as the special refund that was given to taxpayers for a refund of 2020 taxes due to a state surplus. House Bill 1320 is just the adoption of federal tax changes into state law. House Bill 1437 are changes to the tax rate exemptions and exclusions, and we'll cover the several changes in there. Senate Bill 87 allows for direct refunds to the Technical College System of Georgia Foundation. And finally, Senate Bill 361 regarding the Less Crimes Act. So for the first House bill that we're going to cover is House Bill 275, the increase to living organ donor deductible amount. And this change was an increase to the maximum deductible amount for living organ donations by individuals to 25,000. Previously, it was 10,000 for unreimbursed travel expenses, lodging expenses, lost wages, and these expenses had to be incurred for making a living donation for all or part of a liver, pancreas, kidney, intestine, lung, or bone marrow. And the legislation states that this change is effective for taxable years beginning on or after July 1st, 2022. So for individuals, that would mean it would begin in 2023. Next is House Bill 424. This is the qualified foster child donation credit, and this credit starts on January 1st of 2023. This is a new income tax credit, very similar to a lot of the credits that we have out there, such as the qualified education expense and rural hospital credit, where for this credit, donations made to what's called foster child support organizations are apply for pre-approval for a tax credit to be taken against income tax. Taxpayers must file for the pre-approval through the Georgia Tax Center, and they must make the donations to organizations that are certified as qualified organizations by the Department of Human and Health Services. And the credit amounts from the period between the January 1st and January 30th or June 30th of every year is for singles and head of households is $2,500, or for married couples, $5,000. And for those who are members of a pass-through entity, the maximum amount is $5,000, and the corporations, the maximum amount is 10% of the corporation's income tax liability. But after the June 30th date, credit pre-approvals are not limited to the above amounts. And the aggregate annual cap for this credit is $20 million per year. Next, House Bill 469 makes changes to the historic rehabilitation credit. It extends the sunset date previously, which was ending in 2022, to 2025 for historic homes and 2028 for certified or for other certified structures. And the credit caps for the historic homes and the certified structure are also different. For the credit caps for historic homes, it's $5 million per year for 23 and 24. And for the certified structures other than a historic home, it's $30 million per year for 2023 through 2027. Another additional change that's not listed here is that insurance companies, actually, I'm getting ahead of myself. There was another credit. I apologize. Okay.
No problem.
Sorry, go ahead, Richard.
I said, no problem. Thank you. You're doing great. It's great.
House Bill 517 is the qualified education expense credit for donations made to student scholarship organizations. And this is applicable for taxable years beginning on January 1st, 2023. In the House bill, the credit amounts have increased, as you can see on the third bullet. For single or head of household, the increase is from $1,000 to $2,500 per tax year. For married couples, it's now $5,000. Previously, it was $2,500. And for members of a pass-through entity, the maximum amount that they could get for the credit is $25,000 per year, which was an increase from $10,000. And the aggregate amount of tax credits is now capped starting in 2023 is $120 million for all years until for all years. Previously, it was capped at 100 million up to 2028 and 58 million from 2029 and so on. But the legislators made the change to 120 million for this particular House bill. The bill also allows insurance companies to receive the credit for state insurance premium tax owed. So the insurance companies, when they're getting pre-approvals for the credit for the premium tax owed, it's not for income tax. It's for the gross direct premium tax that insurance companies pay. And the credit amount is the actual amount donated, or 75% of that insurance company's insurance premium tax liability. But each insurance company can only get a credit up to $1 million. And also under the previous bullet, there was a cap for 120 million for tax years 2023 and onwards. But insurance companies in total can only get $6 million out of the total cap. And the House Bill 517 also adds additional reporting requirements for student scholarship organizations, such as including the average scholarship amounts that are received by scholarship recipients, categorized by county. And they also add a lot of deadlines and additional submissions, such as the Form 990 and also certain contribution audit reports. You can look at those requirements under OCGA section 48-7-29.16. And the reporting requirements are effective July 1st of 2022, even though the credit changes are occurring in January 1st, 2023. Next is House Bill 586. This House bill extends the period for the conservation tax credit. Previously, it was expiring on the 2021 tax year, but now the House bill extends that credit through December 31st of 2026, but the credit cap is now $4 million per year.
Hey, Jarder, you've
Yes.
mentioned credit caps a couple of times on a couple of slides. Would you explain to everybody what that means when you say credit cap, the cap on the credit?
Okay, sure, I can do that. So I'll just go back to, say, the House Bill 517 slide. So we have the annual aggregate credit cap of $120 million. That means this is the total amount of credits that can be claimed by taxpayers for that particular tax year. So say if we have a married couple filing a joint return, the maximum cap that they could get for their return is $5,000. That means we can only accommodate about, what's that, 200 or 2,400,000? Maybe my math is wrong. About 2.5 million of these taxpayers could apply for pre-approval, but after that, there will be no more credits given to any other taxpayers that
So then that kind of dovetails into my next question. Everybody has to get pre-approval for these cap credits.
Right.
Right. So do you kind of have a system whereby you determine you're going to allow only so many for married couples, only so much for individuals, or do you just wait to see who's applied and whatever number they are in line, they get priority? And if it happens to be all married couples seeking that credit, then, and the credit, you know, you've reached the limit, then that's it. You don't go any farther, or do you have buckets for capping the credit? I don't know if that makes sense. You see what I'm saying?
Yeah. And this House bill is actually a good example of both your questions, or both parts of your question. So taxpayers apply for pre-approval through the Georgia Tax Center, and it's a first come, first served basis. So let's say those 2.5 million married couple filers apply for pre-approval first, they get all the credits first. And anyone after that, if there's credits left, they would get the credit. Regarding the buckets for House Bill 517, this is special. There's actually going to be a separate bucket for the insurance companies because they're allocated $6 million out of the 120 million. But if there's no insurance company applying for any credits, all of the 120 million still goes to taxpayers for income tax credits.
So what you're saying is if all of there's still $6 million left, the insurance companies are supposed to get at least 6 million. And if they don't use the full 6 million, then it goes to anybody else in line who might be an individual or a couple, just a normal taxpayer or any other taxpayer. Okay, Great.
Right. Good questions. Thank you. Okay, so I will move on to House Bill 1041. This House bill just increases the aggregate credit cap for qualified rural hospital organization expense to 75 million per year. So that means more taxpayers will get more of the credit. And this bill is applicable to taxable years beginning on or after January 1st of 2023.
And Charter, are you familiar with this credit? Are you able to somewhat, are you able to tell everybody what who gets to get a credit? I assume
Okay.
for some kind of contribution to whatever a rural hospital is. I'm assuming the East Cobb Northside Hospital is not a rural hospital, so I don't think that would count.
So there is a list of rural hospital organizations. The list is actually maintained by the Department of Community Health. They're the ones that certify and rank the rural hospitals based on need. So any taxpayer that makes a donation to the rural hospital, they can apply for the credits. And there are some, and in the Georgia Tax Center, it allows you to designate the donation to a specific rural hospital. You can also choose not to designate to a specific hospital, and that donation will be given to the rural hospital with the most need. But generally, the taxpayers, any taxpayer like individuals, they just apply for pre-approval through the Georgia Tax Center.
And the Georgia Tax Center is the web portal. Everybody should be familiar with that, but if you're not, it's the Georgia Tax Center is the web portal, the website through which returns are filed and through which you make estimated tax payments. It's sort of the splash page for the Department of Revenue other than the main website. I guess that's the best way to put it. Okay.
Yeah, and it's also a place for practitioners to manage and access their client accounts. You just have to go through a process of registering as a third-party filer, and then you'll be able to get access to your client's information and handle the state income tax issues from the Georgia Tax Center.
Okay, great.
Okay. Moving on, House Bill 1044. This House bill has two parts. The first part, which is the biggest part, is it allows counties, 3 to 5 contiguous counties can form a regional industrial development authority. And this House bill regarding income tax, it makes changes to the quality jobs tax credit, where taxpayers would qualify investment property. And for those familiar with quality jobs tax credit, the investment in property is based on tiers regarding the counties. So the taxpayers with the investment property located within the authority can claim the job tax credit, and the credit amount is based on the lowest tier of the participating county within that authority. And the credit amounts, the lower the tier, the higher amount of credit. So this also presents an interesting wrinkle where taxpayers, while they might be doing business in a higher tier county, they could get credit by creating jobs in lower tier counties as long as they're members of these authorities.
And Charter, can you tell everybody when you say tier, a higher tier, lower tier county, what specifically are you referring to there?
Okay, so there is a ranking of 150 of the 159 counties in Georgia. I believe the ranking is done by the Department of Community Affairs. Correct me if I'm wrong, but it is based on like the economic statistics, such as like the average, I guess, poverty level and the average household income of the population within those counties.
Okay.
The Department of Community Affairs ranks those counties, and tier 4 is the lowest tier, while tier 1 is like the highest tier. Like tier 1 would be counties such as like Fulton or DeKalb, if I'm wrong. then correct me. Tier 4 are a lot of the like counties that are outside the city or more rural. So we try to encourage, I guess, companies to invest in these outer lying counties by giving them more credits for jobs created there.
Great.
Okay. Thank you for that. Next is House Bill 1058 regarding consolidated income tax returns. So previously, before this House bill, affiliated groups, they had to apply for approval from the commissioner to file a Georgia consolidated income tax return, even though they might be filing consolidated income tax returns on the federal level, they still had to get permission from the commissioner. But beginning on January 1st, 2023, the affiliated group can just make the election to file consolidated just by checking an election on the originally filed return. And the election is irrevocable and binding for 5 years. And those who are already filing consolidated, all right, my mouse just rolled, so let me that. Okay. And for the affiliated groups, those who are filing consolidated already, they can continue to do so before the House Bill 1058 changes under the previous criteria, or they can terminate their previous election and make a new election under the House Bill 1058 amendments. Next is House Bill 1064, is the military retirement income exclusion. This is a deduction. Actually, no, this is an exclusion, sorry, for individuals under 62, and they can exclude up to 17,500 of military retirement income. And an additional exclusion of 17,500 is available for individuals who have Georgia earned income that exceeds 17,500. And a little bit of a tax planning, I guess, for a very small group of people is that if the individuals happen to be permanently and totally disabled, any leftover military retirement income exclusion that was not or any leftover military income that was not excluded under the military retirement income exclusion can be excluded under the disability retirement income exclusion. People also know that as the normal retirement income exclusion, which excludes all kinds of retirement income such as interest, dividends, but in the legislation, it did not specifically exclude one exclusion from the other, or it did not forbid taxpayers from using both exclusions. Next is House Bill 1302. This is the special refund that most taxpayers may have received by now. This was the refund of some or all of the 2020 income tax returns. Because the state experienced a revenue surplus, the state of Georgia decided to give some of that money back to those who paid into that the state's budget. The refund amount is the lesser of the 2020 income tax liability or the following amounts based on filing status. Singles, they could get, or singles and married filing separately, they could get $250. Head of household filers, they get $375 or less, depending on income tax liability, and then married filing joint was $500. And in order for these taxpayers to get the refund, they had to have filed both the 2020 and the 2021 returns by the 2021 return deadline, including the extension deadlines. House Bill 1320 is just a really long bill that adopts certain federal tax changes into state law. And some of the more prominent provisions in that House bill includes adopting provisions in the Infrastructure Investment and Jobs Act that were enacted on and before January 1, 2022. And then also adopted provisions that change or affect in any manner of Section 118 of the Internal Revenue Code. But regarding the Commissioner's authority, in addition to adopting the above federal tax changes, House Bill 1320 also gave additional authority to the Commissioner to extend the filing date for an income tax return due to a federally declared disaster resulting from a significant fire. There were other disasters in that list, but this House bill just adds significant fire to that list. And then House Bill 1437, these changes actually start in 2024, and there's quite a few changes. First is the tax rate starts phasing down from 2024 through 2029. For 2024, the tax rate will be 5.49 and it'll go all the way down to 4.99 in 2029. And you can kind of see the tax rates per year on this schedule here. Additionally, personal standard deductions are eliminated, but personal exemptions are increased as follows. I believe this is sort of like the opposite of what the federal government did, where on federal taxes, they doubled the standard deductions while eliminating the personal exemptions. But here, the personal exemptions for Georgia will be increased to 12,000 for individuals and head of household filers. For married filing jointly, the personal exemptions will be increased according to the schedule shown on this slide. And then married filing separate will be half the amount listed for the married joint filers. Additional changes in House Bill 1437 include, so now, or in 2024, $5,000 of earned income can be characterized as retirement income for purposes of the retirement income exclusion. And also the amount of state and local taxes that may be excluded from Georgia taxable net income is as follows. For individuals, head of household, married filing joint is 10,000. For married filing separate is 5,000. And if taxpayers deducted more than those amounts on their federal return, they are required to add those amounts back on their state return as an adjustment. Next, Senate Bill 87 regarding direct tax refunds to the Technical College System of Georgia Foundation. Starting in 2023, taxpayers are allowed to direct their tax refund amounts by checking an election on their tax returns to send that money over to the Technical College System of Georgia Foundation. And the funds will be used exclusively to provide scholarships to veterans with service-connected disabilities who also attend the Technical College System of Georgia. Lastly, Senate Bill 361, this is the Less Crimes Act, which gives a new credit, which we call the Qualified Law Enforcement Donation Credit. Starting in January 1st, 2023, taxpayers who donate to nonprofit law enforcement foundations that support local law enforcement units receive a tax credit against Georgia income tax. And like all the other credits we talked about previously, they have to apply for pre-approval through the Georgia Tax Center. And the credit amount is the lesser of the amount donated or the following amounts, which are for individuals, head of household, and those filing married separate is $5,000. For married filing jointly, $10,000. For members of a pass-through, $10,000. And for corporations or other electing entity, is 75% of the entity's income tax liability. Here for other electing entity, for those who may have been following tax changes for the last 2 years, the other electing entity is the change from, I believe, House Bill 149, which allows pass-through entities to elect to pay income tax on the entity level instead of passing it on to their members, partners, or shareholders.
And Charter, will there be a list of what qualifies as a nonprofit law enforcement foundation, or is just anybody who calls me up on the phone qualified?
So in this Senate bill, the Department of Revenue is actually the agency that certifies these foundations. And we have a list on our website regarding the foundations that have been certified by us and that are I guess, that qualify for the tax credit program for taxpayers.
Great.
Okay, so that covered all the legislation. Next, I'll just briefly go over the regulations that were promulgated by the agency this past year. First, we just have the rural physicians credit, and this was just an update to use the 2020 census to define rural county. Next is the railroad track maintenance tax credit, which we just updated the regulation to change the sunset date from 2024 to 2027. And then for the next two regulations that were promulgated, they were just promulgated to reflect changes in their prospective House bills. The conservation tax credit was updated to reflect the changes in House Bill 586. The regulation for the Rural Hospital Organization expense tax credit was updated to reflect changes in House Bill 517. And then recently, we just issued a proposed rule for the qualified law enforcement donation credit. This was the credit that I just talked about in Senate Bill 361. And this is, we just gave that proposed rule out on the website, and then it is pending adoption into the OCGA. Lastly, we
Excuse me,
issued
Jarder.
Sorry, yeah.
Jarder, hey, well, this is Richard. Do you expect any rulings, or I'm sorry, not rulings, but do you expect any regulations to be promulgated this year, or at least adopted this year
So
in 2023?
So we are going to issue regulations regarding changes to the other credits. One that is being slated is the historic rehabilitation credit.
Yeah.
And the other one is the qualified foster child donation credits. There were other, I guess, regulations that we are reviewing, and we will promulgate them as soon as we make changes to those.
Great.
Okay. And then lastly, I'm just going to cover the policy bulletins that was issued by the income tax group. First is the guidance to House Bill 481, the Living Infants and Fairness, Equality, Life Act. This is also known as the Heartbeat Bill. And within that bill, a personal exemption was issued for unborn children with a detectable human heartbeat. And in that policy bulletin, we issued some guidance and information on how to claim that unborn child dependent exemption, but additional instructions and details can be found in the IT 511 booklet.
Jarder.
Yes.
So this is the heartbeat bill. This is the bill that says if there's a heartbeat after 6 weeks, it's considered a living being, so to speak. And for purposes of the bill, it includes an exemption. Has the department considered perhaps something? I mean, what happens if at 9 weeks there's no heartbeat and there's a miscarriage? Do you know whether the exemption, y'all may have not addressed this, but do y'all have a position yet on whether that would still qualify for an exemption? So like, let's say in June of 2023, there's a heartbeat, but then in August, the heartbeat goes away and it's miscarriage. Would that still qualify as an exemption? Or does it have to be at a certain time at the end of the year?
So the child that unfortunately ends up in a miscarriage, the taxpayers will also qualify for the exemption.
So you get the exemption even if you have a miscarriage. Okay, good. Okay.
And in that policy bulletin, it says that you just have to have a starting, I believe the date was July 20th, 2022. And onwards, if you have an unborn child with a detectable human heartbeat, you get the unborn child dependent exemption. But if the child is born later in the year, you don't get that exemption. You just claim that dependent as you would for a living child.
Okay.
And then, yeah, we've received a lot of questions, and a lot of the guidance are in the IT 511 booklet. So please, I'm not sure if it's published yet, but once it goes out, please take a look at the booklet for additional instructions on how to claim that exemption. Finally, the last policy bulletin is just the update to the list of rural counties based on the 2020 US Census for purposes of the rural physician credit. And that is it. Here's our contact information. There's Kelsey's email and phone number, and then there's my email and phone number there. Are there any questions?
Well, Jarder, excellent job. Thank you very much. Great job on your first time doing this and
Thank you.
being sort of called in to pinch hit. We look forward to working with you, hopefully meeting you in person at some point. And with that, it is now 2:16, so we'll move on from Jarder's presentation to Charles Elrod, who is filling in for Ann Whipple to update us on sales tax issues, and we appreciate Charles doing this.
Sure. Richard, can you hear me?
Yes.
Okay, good afternoon, everybody. Similar to Jarder, I'm going to pinch hit for Ann, who unfortunately has an urgent matter that she needs to attend to. But unlike Jarder, all of you received at about 10 to 10:30 day, Richard referenced the slides that Lane sent out. Ann's the presentation that Ann prepared. Those slides are in that package. I recommend all of you pull them up. I'm not necessarily going to go by them. I'm going to kind of free flow this a little bit more and just not necessarily stick to script. But with that being said, that is kind of a good outline of what I'm going to.
Charles.
Yes.
For those of us who printed out the slides, like me, if you printed it out in black and white, you cannot read the title of the slide. So if you don't mind, if you could just tell us the title of the slide when you get to it, because I'm making notes on the slides.
Sure.
If you're able to do it, if not, don't worry about it.
Richard, why don't you hold up a piece of paper and show me what you're talking about real quick.
See the title, I can't, it's hard. I printed it out knowing that you were going to be presenting and everybody else was going to be presenting. I printed it out.
So I have the same thing.
Yeah, I don't know. Maybe for some people it's printed okay. I mean, Spain.
Let's do this, Richard. Let me just get started. And
okay.
If there's
Sounds
something
good.
you think that helps troubleshoot and that helps you, that'll probably help everybody else, then just interrupt me. How about that?
Oh, well, that sounds good.
Okay, so, but a lot of it will be kind of the same format that Charter just provided for everybody. So first and foremost, Richard also introduced me. I'm Charles Elrod. I am a senior manager in the Office of General Counsel. Earlier, Frank went over kind of the bifurcation, the breakdown, and the relationships between the Office of General Counsel as well as the Office of Tax Policy. So in my former life at Revenue, I started in the sales tax group. I still liaise with them on a weekly, if not daily basis. And so I am certainly happy to step in and help Ann out here today and the group as a whole. I think that Amy Oneacre is the first person I'm going to introduce you to the team. Amy Oneacre is still the fearless leader and director of the sales tax group. I think she's on the line too. So to the extent we have questions, she can probably jump in and assist me on those as well. The rest of the makeup of the group, let's see here. So Ann, you have Amy as the director. Ann Whipple is a senior manager within the group. And then it has come to my attention in the past week, we used to have a wonderful staff attorney by the name of Amy Casey, who has elected to leave the department. So they're going to be one down without Amy. Recently, we did have a fantastic addition, Yasmin Maddox, who's a legal analyst specialist and who's getting trained up as we speak. And then, so even before Amy Casey's departure, I know that the group had an opening that's openly shopping. I'm not so sure if now is the right time to be able to campaign, but or advertise. But if anybody has anybody out there who they think may be a good fit at revenue, by all means, reach out to either me or Amy One Acre, because I'm quite positive there's at least one job that's being shopped right now. So appreciate you letting me get that in there, Richard.
No problem.
Okay, so what the sales tax group does, very similar in tax policy. It's the same as what on the income tax side of things. The differences, I guess, are primary that sometimes the what they're working on shifts a little bit from kind of the type of day-to-day work that you might have on the income tax policy group. But it is legislation. There's a lot of liaise from a legislation perspective. Sometimes there's even help in drafting statutes. But often once you have the legislation, the group is going to be tasked with any and all regulations that are going to be needed. And then oftentimes in lieu of or prior to a regulation, there's a policy bulletin that may be issued in connection with a certain statute. And then also the group takes the lead on, at some point in the meeting today, Richard brought up protest conference that are, those are codified rights for taxpayers. That is almost like an administrative hearing, or it is an administrative hearing. Keeps costs down for the taxpayers and leads to quicker resolution often. And the tax policy group is in charge of that. And those are come both in the forms of audit protest as well as protest from refund denials. And finally, letter rulings, which I don't think is on the agenda here today, but the tax policy group takes the lead on looking at letter ruling requests and issuing those rulings as well. So that is the nuts and bolts. But as Richard, I think, alluded to earlier, the group also informally is constantly in communication with the public and helping kind of provide informal guidance and give some basic answers to some questions to keep everybody moving in the right direction from a sales tax perspective. So without further ado, I'm going to legislation. As has been the case most years that I've been here, not all, but there was a few proposed bills circulated that were going to have some pretty large impact in the sales tax arena. But at the end of the day, from a 2022 perspective, it really wasn't that much. I think I'm looking at 5 bills here, 4 exemptions, a T-Splosh 2 bill, and then also a Senate bill that affected 911 charges ever so slightly. So without further ado, let's jump into House Bill 1291. And I think how I'm going to do this. I'm going to speak on the bill itself and the statute, and then I might be circling back to any sort of regulation that is currently being proposed. So let's see here. So the high-tech data center equipment exemption is for equipment to be incorporated or used in high technology data centers that meet investment threshold as well as other conditions, including specifically a jobs requirement. So the first thing the bill did, it moved the sunset date out by 3 years from 12/28 to 12/31. But with that being said, beginning back in May, on May 9th, there were some tweaks to the actual, I guess, substantive pieces of the exemption. And specifically, I guess with a theory that of trying to push incentivize companies to move to counties with smaller populations. The first thing that the legislature did was add 5 jobs to the new quality jobs requirement for data centers located in counties that had a population greater than 50,000 people. And then on the flip side, for counties with populations between 30,000 and 50,000, the jobs requirement was actually lowered from 20 to 10. And then along with that, the investment threshold, one of the conditions I just spoke about, was dropped from 150 million to 75 million. And finally, for the smallest counties, for counties that have populations under 30,000, the jobs requirement was lowered all the way down from 20 all the way down to 5, which kind of gives you a little bit of an idea of how many jobs actually created in some of these data centers. But from 20 to 5, and the investment threshold dropped from 100 million down to $25 million. So a big reduction with a huge incentive to get these data centers into some of the smaller populated counties. Okay, so that's 68.1 codified at 48.8.3, 68.1. And then I'm going to flip and discuss 48.8.3.68, which is the change. The amendments were also found in House Bill 1291. And this is for the sale or lease of computer equipment that's to be incorporated into high technology facilities in this state to high technology companies that are, those qualification requirements being set forth in this statute for what companies qualify. So the particularities here, the exemption has been extended for 5 years until 12/31/2028. And unlike the data center exemption, that the changes were effective immediately upon the governor's signature back in the spring, the changes for the high-tech computer equipment exemption found at 68, they're actually going to begin on 1/1/24. So not even the beginning of next year, but when the original exemption was going to expire, that exemption in theory is technically expiring on its own, and the new exemption that starts the next day for the new 5-year period will have a few tweaks, if that makes any sense. The first one, there was a case, a lawsuit that involved whether or not non-taxable purchases actually qualified for the spend, and the spend threshold for the computer equipment exemption is $15 million. And there was the state lost on that issue. And so the legislature has gone back and specifically to kind of make the ruling in the case moot. Now, starting in 1/1/24, non-taxable purchases will be excluded from the $15 million spend requirement. Also, the exemption has been slightly has been softened a little bit, I guess, and just how big the incentive is now for the first $15 million of eligible purchases. The claimant's going to have to pay 10% of the taxes on that. I'm sure there's plenty of questions on exactly how that's administratively going to be conquered, for lack of a better term. I don't have the answers here today, coming from where I'm sitting, but I do know it's been kind of the issue's been bandied about. And we're still working on it. Okay, some exclusions. The definition of computer equipment. One is going to be computers or devices that are issued to employees. And then number 2 is the pre-written computer software that also is going to be excluded. So I'll take the time right now to add, I think many of you are probably familiar with the T-Mobile lawsuit that focuses largely on the definition of computer equipment. I'm not ignoring it. I'm just probably not the best served to speak on that. And I'm quite sure that Ron Stay from the Attorney General's office, who is part of this meeting and going to be speaking and doing a better job directly after me, I'm pretty sure T-Mobile's on his agenda. And so I'll let him give his litigation update, and I'm not going to touch it. So that's it. And let's see what we're going to do next. All right, I'll go ahead and finish the legislation. Most of this is pretty straightforward. So House Bill 586, we have a fine arts exemption. It's 48.8.3.100 is where it's codified. It was effective back on May 10th, I believe, this year. And all it's really going to do is extend the exemption to 12/27. And specifically, this exemption is for the sale of tickets for fine arts performances or exhibitions within a facility that is owned or operated by an organization which is either a 501c3 or is a museum of cultural significance. We certainly have had a few discussions along the way on this exemption. But for now, I think really all it is to share is that the government likes it, and we are going to, it has been extended, and we are going to keep administrators for it. So that's your fine arts exemption. And then House Bill 1034, the sporting event exemption. This one's real simple. Law that worked real well, real swiftly. May 2nd, the governor signed this particular House bill. It amended 48.8.397. Nothing changed. The $50 million of expected revenue generated figure did not change. Well, I guess the sunset did change to 12/31, but really the only reason why I think this House bill changed the statute was to add FIFA World Cup to the definition of major sporting events, and voila, since the governor's signature on May 2nd, sometime in the past, I guess about 90 days, our city was awarded one of the World Cup events, so it worked. Okay, so moving on to House Bill 934. This ties to T-Splosh 2, which are county-specific T-Splosh, if my memory serves me correctly. The changes, from what I understand, is under the prior law, you had to have an estimated threshold for the revenue that you needed for your transportation project for that particular T-Splosh. And the biggest change of this House bill is that if you have an intergovernmental agreement, if you have an IGA, you can have that IGA be up for a total of 5 years, for a maximum of 5 years. And if you do that for 5 years, then there's no spend issue at all that would curtail, or I guess effectively end the T-Splosh, not prematurely, but prior to the expiration of any sort of IGA. So it's a little bit more of it makes it a little bit more lax for the counties and their T-Splosh 2s. At least that's how it's been told to me. Anybody else wants to chime in, I'm happy to discuss it. And then finally, we have Senate Bill 84. This is for changes to prepaid 911 charges and non-prepaid 911 charges. It's not really a big change, at least from an explanation perspective. DOR used to get 1%. Well, that went to the general fund to defray our cost of the administration. That is now going to be reduced down to 0.25%, and the other 75%, in lieu of going to the general fund, is going to the peace officers annual benefit fund. And I do recall that the definition of peace officers has been expanded, so the kind of I think that the groups that can qualify for this particular 0.75% disbursement, those standards have been relaxed a little bit as well. And this particular Senate bill became effective on July 1 of 2022. So, well, Richard, I'll ask you before I'm going to get into just a little bit of, as you have the same handouts I do. I'm going to go back and talk about what's kind of been going on with the high-tech regulation 117.117.
Sure.
Do you have any questions at this point related to any of the legislation that I mentioned? It's
No.
pretty straightforward.
Yeah. Go. That's fine.
Okay. Sorry. I couldn't hear. Okay, so for any of you who have clients or spend much time on the data center exemption, you probably recall, or you will recall, that we put out 560-12, 560-12-2-.117. I believe it was in early 2022. And we put that out for comment, and then we did come close to actually promulgating it, but it was pulled back, for lack of a better term. But the plan is to, in early 2023, it's my understanding that the plan is to put it back out for public comment. I don't think it's going to be necessarily a complete overhaul, but I think that I guess there are two primary points. These are not exhaustive, the list, but I know of 2 points that are going to kind of be focused on when it's put out for additional comment. One, which may or may not even be in the slides here today, is I'm pretty sure the industry and some attorneys are probably on this call today, but we're working on maybe having some language for an appeal process. And what I mean by that is how the exemption is structured is that taxpayers or claimants are entitled to obtain a certificate on the front end for the data center equipment. However, as I kind of touched on indirectly earlier, this exemption is not without conditions. And while to my knowledge, we have not clawed back any tax that was exempted to date. We do have the right to revoke a certificate and claw back taxes that were exempted out. And it's just my understanding that, as opposed to just unilaterally doing a clawback and a revocation of certificates, that we were contemplating.
Hey, Charles,
Yes.
would that be sort of as a result of an audit, I guess? Just a random audit to determine whether the equipment qualifies?
Richard, I mean, that just seems to make the most sense, right? I mean, I couldn't really think of another situation where
Right.
that would
Could
necessarily.
I chime in here?
Sure.
I'm sorry, this is Amy Oneacre. I think the procedure that we're discussing in terms of the appeal process would be in the event that the department is determining to revoke somebody's high technology data center exemption because they did not meet the minimum investment threshold, which, as Charles mentioned earlier, is a combination of both a dollar investment figure as well as a number of new quality jobs. And so these high technology data centers qualifying for the exemption have a certain amount of time to meet the minimum investment threshold. And if they don't meet the minimum investment threshold, then there is the potential for the department to claw back the exemption and revoke the certificate. And so I think the industry is quite interested in there being an appeal process of some kind, which we do not disagree. That would be a great idea to have. We are working on language for that, but I don't know that it would necessarily be a routine audit, but it would be some type of review or audit to determine if such data center had met the minimum investment threshold. So probably different than a standard audit.
Great. Thank you very much. For those of you who don't know, that's Amy Oneacre, the director of the sales tax group at the in the Office of Tax Policy. Thank you, Amy, for chiming in.
Thanks, Amy. I obviously got out of over my skis a little bit. Sorry about that. And then the second, I guess, bullet point for proposed rule 550-12-2-.117 is some potential tweaking and broadening of the definition of data center owner. When this exemption was first rolled out, I don't think that the revenue, and perhaps even the legislature, had a full grasp on how these centers were going to be owned. A lot of entities that own various aspects of the data centers. And so the goal, and I think what we've accomplished, or what we're trying to do to date, is to make sure that we don't deny taxpayers who are rightfully due the should receive the exemption. So the data center owner definition is by regulation would be broadened to include related members, which is codified in a different part of the code of 48-7-28.3. And what that would allow to have happen, looking at the slide, you can flip to the next page. So the related members, they would be able to apply for the exemption certificate. Now, only one entity per data center could apply, but the related member could actually apply for the exemption certificate. And then these related members could also, they would be able to use the data center exemption certificate and for purchases, and also hire employees, that the employees that they would hire would help meet the qualified jobs threshold, and the purchases will also go to the investment threshold. So finally, they'd be able to contract customers who can apply for a data center exemption certificate as well. On the flip side, and I don't really want to take a deep dive here because it touches on the income tax side, into the tax world, but there is a little bit of a stick as opposed to all the carrots and incentive side. That's that related members are restricted from taking Georgia income tax credits for business activities related to the data center if the related members make qualifying expenditures, make exempt purchases, hire the qualified job employees, or contract the customers for services of the data center. So it's just something that companies have to be aware of when they're, I guess, looking at tax planning or looking at the opportunities within Georgia to make sure that they don't, I guess, double dip on both the sales tax exemption side and then also be looking at it from an eye towards income tax credits. So that's my comment there. And then finally, on the same exemption proposed regulation, let's see here. Well, we already talked about the old requirements being in effect prior to May 9th, 2022. So those old requirements will still apply. And then finally, a hot topic that ever since COVID is people are always asking all across the country on various exemptions about teleworking and how that might be able to, whether a company could have some qualified jobs for teleworkers. From what I know, and I think it is what's in even the, perhaps even in the last regulation that went out for public comment. But what we're currently contemplating is that there's a 30-hour requirement for the employees in the statute, and revenue is ready to go forward with regulation. Regulation says that the 30 hours needs to be just simply worked within the county. That doesn't necessarily mean you have to work at the facility, but it would be a county telework, I guess, as opposed to a state telework or even and definitely not a national telework. That's just where we are at this point. But nothing codified. That's that. And then how are we on time? I guess
You've got about 10 minutes.
And so I'm not going to be able to probably fill the whole 10, but we can certainly open up for a question or two. The only policy bulletin that I am aware of from 2022 from the sales tax group is related to municipal option sales tax, kind of lesser known option sales tax tied specifically to municipalities. And it simply is that House Bill 160 authorizing municipalities that operate a wastewater system that interconnects with a wastewater system of a municipality that has an average wastewater flow that is not less than 85 gallons million per day to bring a referendum to levy a most. And 3 cities, College Park, East Point, and Hapeville, they pursuant to the House bill, they levied the most effective 10/1/22, and supposed to do, in fact, under the new law, to make sure that they are eligible for that notice. It applies like most other option sales tax, but it specifically does not apply to sales or use of motor vehicles. That's really it. That's all I have for main slides. If there's anything you want to bring up, Richard,
Well,
I'm probably happy to answer.
no, Charles, that's great. We truly appreciate your filling in for Ann, and you did a great job. And thank you very much. And we're gonna move ahead. We're gonna move ahead now to Ron Stay, who is going to give us his litigation court decisions update. And Ron, I'll just tag you in and let you go with, and everybody should have your handout that lists all the cases of significance for the year. And I'll
Okay,
let you
great.
go, Ron. Thank you.
All right, thanks, Richard. Can you hear me okay?
Yep.
All right, good. Thank you. It's good to be here with everybody. I'm Ron Stay. I am the section chief of the tax section at the Attorney General's office. And I guess before I go down my list of cases and disputes from the past year, a brief word about who we are and what we do for those of you who may not already be acquainted with our office, or at least our section. The Attorney General's office, of course, is a branch of government, the constitutionally elected Attorney General, and we run kind of like a law firm. We are organized functionally by different areas of the law. The tax section is contained in the commercial litigation and transactions division. So we have a division that generally handles all kinds of business related matters. We are a section or a subgroup of that division. There are, let me count up, 6 of us, 6 attorneys in the tax section. And I guess the best way to describe what we do is we are general representation for the Georgia Department of Revenue. I mean, that's really mostly what we do. I think if you kind of think about the split, looking back at the way Commissioner O'Connell explained, their Office of General Counsel, we kind of act like an outside counsel to the Department of Revenue. And then lawyers like Charles are like the in-house counsels. So one particular thing is that the Attorney General's office statutorily is the entity that, the only entity that can represent the department in court. So as a result of that, I think mostly what we do, much like an outside counsel, is we handle disputes. I handle disputes for the Department of Revenue. That's the lion's share of what we do. A lot of that revolves around the tax tribunal, which I'm sure most all of you are familiar with. But it also includes handling a lot of other things for the Department of Revenue, like alcohol licensing, tobacco, fuel tax, the other functional areas of the department. We do give the department some general advice from time to time on various issues. And we do represent the department in litigation in state, or mostly Superior Court, the Court of Appeals, and the Supreme Court. Some of that litigation naturally arises from the tax tribunal if someone decides to appeal a decision to the tax tribunal, but some of it will originate in the superior courts, like, for instance, a lot of assessment appeals for centrally assessed utilities like railroads or electric companies or airlines, things like that. So it's really quite a wide variety of things. That's kind of what we do. What we don't do, or maybe what we generally don't get too involved in, and I guess for purposes of talking to practicing lawyers, this is just one thing I would mention: advisory opinions. We often get called upon a lot by practicing lawyers, and that includes lawyers representing private clients, as well as lawyers who are representing local government entities. to kind of give advisory opinions. In other words, hey, we've got this dispute going on. You're not involved in it, but can you kind of tell us your opinion as to what the law says about this or what the law says about that? Kind of settle an argument or weigh in on one side or the other. We do get those inquiries, with some regularity. We're pretty limited as to how we can respond to those. Unfortunately, as much as we want to be helpful, as much as we want to, serve the public, which is of course part of our charge, our client is the department and more generally the state. So we are very, very limited as to whether we can kind of wade into disputes or wade into legal interpretations to third parties. We will try to help. That is something that oftentimes the Department of Revenue can take on, depending on the nature of the question. We can work with them to try to help you coordinate with them. So I'm not saying don't call, but I am saying that, sometimes we can't respond to those. And sometimes we have to defer. Now, if the answer is abundantly clear, which it sometimes is, or if it's just a question of pointing somebody to some resources, we're more than happy to do that. But that's basically who we are. And the reason we're here today is to kind of summarize some of the significant cases, generally court cases that we've handled over the past year. There's a detailed listing in your materials. The detailed listing is for your reference. It contains all of the gory, nitty-gritty details, including case citations and everything else, if you want to go back and look any of this up. But I will note, finally, before getting started, that some of these that we're going to talk about are carryovers. Of course, the litigation that we handle, like the litigation a lot of lawyers handle, can go on for years. So some of this stuff is the same cases as last year's update, just updated for recent developments. Some of it is new. So with that preface, let me start. I'm just going to go down in the order that they're listed in the materials. They're not really in any order other than we tried to group them by area or function or something. I mean, it's a really loose grouping. So, but there's not any real significance to the order. The first ones we had were in the general areas of sales and use taxes. Then the first one I'll talk about, which Charles just mentioned a minute ago, is the T-Mobile case. And this is a carryover from last year. What's going on in T-Mobile, generally just kind of start with the question is, it's the high-tech exemption. The high-tech exemption has been mentioned a few times today. That's a sales tax exemption that, to put it crudely, applies to computer equipment. But the real issue in the T-Mobile case is not the exemption, but the exclusion to the exemption. The exclusion to the high-tech exemption that we're litigating in the T-Mobile case is the one that's related to, quote, telephone, central office equipment, or other voice data transport technology. That type of stuff, provided you meet all the other requirements, that is excluded from the exemption. And in this case, T-Mobile spent quite a bit of money on upgrading and installing its LTE network. LTE is the acronym. It stands for long-term evolution, but it's the cell phone technology or the mobile phone technology that came kind of right before 5G. So probably a lot of you have that technology on your phones now. And the question posed by the T-Mobile case was whether or not T-Mobile's investment in LTE technology in the state of Georgia was subject to the high-tech exemption, or whether it was excluded from that exemption because it is telephone, central office equipment, or other voice data transport technology. And I think this case is another, like so many of the cases we're seeing nowadays in tax and in other areas of the law. It's really one of those questions of, statutory language, can it keep up with rapidly evolving technology? And so kind of the issue here is that LTE technology was kind of, designed to be data centric, right? It was, cell phones, smartphones coming of age, and so much of what we do on a smartphone is not talking, it's driven by data. And LTE, according to T-Mobile's, contention was, a data-driven technology. It's not voice technology. It's computer equipment. It's not telephone equipment in the classic sense that we think of telephone equipment, switches and the things in the switch house that drove voice calls. And because LTE, was, in their view, computer equipment and not telephone central office equipment, it was not excluded from the exemption. T-Mobile won that argument in the tax tribunal when they filed their tax tribunal case. The department then appealed that decision to the Superior Court of Fulton County. While that Superior Court matter was pending a couple of years ago, there was a clarification that was passed, or a statute that was passed in the legislature that basically kind of tacked on to the statute that telephone central office equipment or other voice data transport technology also included wireless telecommunication systems. And while that hasn't been front and center stage in the litigation so far, it is something that is of relevance. It has been mentioned in the rulings. So what wound up happening is that in this past year, what wound up happening is that the department won in the Superior Court. The Superior Court reversed the tax tribunal and held no. The LTE investment was in fact telephone central office equipment or other voice data transport technology, because they were looking at the term voice data transport technology. And I think the key, or the underpinning to the Superior Court's opinion was, it can transmit voice data. You can talk on it. There's no dispute that as data centric as LTE may be, you can in fact make a voice phone call on it, just like you can make a voice phone call on your computer. You can do that via your cell phone with the LTE technology. So what that was before this past year. What's happened in the past year is that that opinion was appealed by T-Mobile, and now we're in the discretionary appeal stage when a case is resolved in the tribunal. Your appeal as of right is to Superior Court, but if you're going to go beyond Superior Court, then you have to apply for a discretionary appeal with the Court of Appeals. And then if you want to go beyond that, it's a further, application in the Supreme Court. But in this case, T-Mobile applied for discretionary appeal and was granted that. And in this past year, the Court of Appeals ruled, and they reversed the Superior Court. And what the Court of Appeals did was a little bit, it's not quite final. What they said was the trial court, the Superior Court rather, applied the wrong standard of review. In the Superior Court, Judge Brasher had said, or had held, that the LTE equipment was, quote, intended to permit voice calls. The actual quote was, it's capable of and intended to permit voice calls. That was part of his holding. And what the Court of Appeals said is that last portion, intended to permit voice calls, kind of intruded upon the fact-finding province of the tax tribunal, because there was a factual finding of the tax tribunal that had said that LTE was not intended to permit voice calls. And so, when we're in the appellate stage with the tax tribunal, it's kind of axiomatic that factual findings can only be disturbed if they're clearly erroneous, or there's basically no basis to support them. So it's a very, very high standard. And so what the Court of Appeals said is, look, you said it was intended to permit voice calls. The tribunal said it wasn't. So if you're going to say that, then either you got to do one of several things. You've got to either say it was clearly erroneous, explain why. You've got to say it wasn't based on any reasonable basis and explain why, or you've got to redo it in some other way. So what happened was they reversed the trial court, but then they sent it back and said, we're not really taking a position as to how the case should come out. We're just telling you that, when you did your opinion, you used the wrong standard of review, and you got to fix that and fix it however you like, but, use this opinion as guidance and get back to us. So that's where we're at right now in the T-Mobile case. So we have no final resolution because right now it's been rebriefed in the trial court, or in the superior court rather. And that happened a few months ago, or actually in October. And we are awaiting a ruling. All of you, or many of you may know, Judge Brash is leaving the bench in just a couple of weeks, I think. And so we're not sure if we're going to hear from him before he leaves the bench, or whether or not he'll punt that to his successor, who I'm not sure has been named. But that's the state of the T-Mobile case. It goes on, but probably in 2023 we will see further evolution and maybe a final resolution of that case. Secondly, on our list is carryover from last year. Not a whole lot happened this year, but I just want to update you. The executive limo case, and that is worth mentioning because it impacts the next case we're going to talk about, which is the Uber case. Executive limo was a case that was filed in the tax tribunal initially, along with another case called Divine Chariots Limousine. These are limousine companies. Basically, they hire out limousines. These limousines are operated by, I guess you could call them independent contractors. They're drivers who own their own vehicles and contract with the limousine company to basically send them out on trips. And so the issue presented was, who should be collecting the sales tax? All know that transportation services are subject to sales tax in Georgia. But the question is, who's collecting it? Should the limo drivers, who are supposedly independent drivers, be collecting it, or should the limo company who's sending them out be collecting that sales tax? There were a few different arguments raised in the executive limo case, that they were independent, that they therefore did not work directly for the limousine company in a traditional employee sense. Also, that there was an argument made, since professional services are exempt from sales tax, they said, we're providing a professional services, these drivers are professionals, et cetera. And what happened was the tax tribunal ruled in favor of the department. The reason they ruled in favor of the department, and this goes back a couple of years, is that what we call the headquarters regulation, the taxi cab headquarters regulation, that is found at Georgia Comp Rules and Regs 560-12-2.84. And that rule and reg, basically, they call it the taxi cab headquarters regulation because it starts by referring to taxi cabs, but it also refers generally to cars for hire. And what it says is that, to put it bluntly, and we'll talk about this in more detail in a minute, if you run a headquarters operation for taxi cabs or cars for hire, if you're basically dispatching them, then you collect the sales tax, long and short of it. And in this case, the tax tribunal and then Fulton Superior Court, when it was appealed to Fulton Superior Court, and then just this past year, or then in 2021, rather, the Georgia Court of Appeals all held, affirming the tribunal and affirming the department's position that independent limousine operators working for working out of a headquarters operation are subject to the headquarters regulation. In other words, the headquarters outfit, which in this case is Executive Limousine Transportation, has to collect the sales tax under the reg. And what all of these entities basically held is that they're not professional services within the meaning of the sales tax statutes, because I think, and this is the direct quote, transportation is at the heart of what's being sold. So they're really, what's being sold here is transportation, not professional services. And that this clearly falls under that headquarters regulation rule, because as we'll see in a minute, it's a very simple reg. And these companies were dispatching the cars, they were taking the calls, they were sending out the cars, and the money was flowing through them. And the fact that the limos themselves were not owned by the companies, the fact that the drivers of the limos did not work for the company in a direct employee relationship was not relevant. And that's really the upshot of the executive limo decision. I think really the most important thing we can take from it is that if we're going to use that headquarters regulation in a sales tax perspective, the nature of the employment relationship between the drivers and the entity is not determinative. Who owns the vehicles is not determinative. They're not meant, that's not mentioned in the regulation, and it's therefore not going to be something that is considered. So executive limo, most of those events happened prior. What happened in this past year of note is at the very end, there was a petition for cert that was filed by the limo company, and that was denied in June of 2022. So this case is now final. It's law, and it's the end of the line for that particular set of facts. Divine Chariot's limousine, which is kind of a companion case, is still down at the tribunal, and they were awaiting the outcome of the Uber case, which we will now talk about because it is somewhat related. Uber presents a somewhat similar question, which is, we all know who Uber is. Does Uber's particular model of business, who collects the sales tax there? Is it Uber or is it Uber's drivers? And of course, the significant wrinkle in Uber is Uber itself is not I guess not what most of us would think of as a brick and mortar operation. Rather, we think of it more as a virtual operation, something that resides on our phone. Of course, they have a physical presence in some way, but the nuts and bolts of how it runs are mostly done in cyberspace. So Uber's, of course, been pending before the tribunal for a while, but we've had quite a few developments in the past year. Uber was basically the same questions or similar questions that were presented in executive limousine. Who's selling transportation services within the meaning of the sales tax statute? Does the headquarters regulation apply? And that kind of a thing. And on that note, I'll also mention that the headquarters regulation, has now been considered by the Supreme Court of Georgia, both in executive limo and also in an older case, Collins versus Adam Cab. It's been considered a couple of times and it's been upheld. So evidently, the Supreme Court of Georgia seems to think it's a valid regulation, a valid exercise of the department's regulatory authority. But in Uber, we updated y'all last year. It was still going in litigation before the tribunal. And in this past year, some of y'all may have seen in November, the rulings were published. The department did win a summary judgment in the Uber case. They won a summary judgment as to liability only, which meant that it was determined that Uber and not Uber's drivers needed to collect sales tax. And I will clarify for you, it's in the written materials. This is all, of course, in the period prior to the ride sharing tax structure was put into place in 2020. Now we have a specific tax structure for ride share companies that the legislature enacted. This is for the period prior to that, the audit periods that run before 2020. But the department was granted summary judgment, and that was in May of 2022. They were actually cross motions, so the department's motion was granted and Uber's was denied. Those rulings were published by the tribunal, I think, a couple of weeks ago in November, beginning of November, middle of November. You can find them on the department's website. But basically what happened is the tribunal determined they didn't really need to analyze the issue of whether Uber provided transportation services under the Sales Tax Act, because we could just get to the end point by looking at the headquarters regulation, which, as I mentioned, had been considered and upheld by the Supreme Court in both the Adam Cab and the very recent executive limo case when they denied cert. And that regulation, 560.12.2.84, is really, really simple for tax regulation. It's not very many words for something that deals with taxes, a complex issue like that. And what it basically said is that, headquarters operators, and the statute says taxi cab headquarters operators, but then it also says that independent or cars for hire are considered in the same manner as taxi cabs. So headquarters operator of cars for hire has to collect the taxes, and it kind of defines that what a headquarters operator is in a very simple disjunctive of basically three kind of alternative factors. The first is, are you operating a headquarters and supervising or directing drivers? Or are you receiving or relaying calls to drivers? Or are you allowing drivers to use the trade name or hold themselves out as being affiliated with you? So pretty broad, pretty simple. And in this case, the tribunal determined that all three of those things, or possibly all three, but at least one of those things applied to the way that Uber does business in the state. The Uber app, it determined, was basically a function as a headquarters that supervised or directed drivers. The app itself is what directs the drivers to riders. And the app itself is, what, lets the drivers know where the riders want to go. Without the app, the drivers and riders wouldn't get together. So it considered that a headquarters, and there's no physical headquarters in the same sense as there's a brick building with people in it answering the phones, but that's not in the reg. And the tribunal, at least it's been my experience, is pretty stringent about applying the plain text of statutes and regs. And it noted that, even though there's not a physical infrastructure, Uber had described the app as a kind of or described itself as a provider of electronic infrastructure. So again, like what we're seeing in T-Mobile, we're seeing, regs and statutes that, were written in the days before smartphones and before this advanced technology, now being applied in a more modern environment. Secondly, the tribunal said that the app itself receives or relays calls to drivers. They're not telephone calls, but certainly when you press the button to say, I want to ride, it goes through the app, and that reaches out to a driver and lets drivers or potential drivers know what you want and where you want to go. And finally, as a practical matter, the trade name thing was interesting because, during the audit period, it was noted that, there was a limitation or an inability for drivers to use Uber's trade dress or trade name. That's changed nowadays, but at that time it was different. But the tribunal's position was, as a practical matter, the drivers had to be able to hold themselves out as being affiliated with Uber in some way, because, if you summon the car, there is a natural implication that the car that's summoned and that shows up at the precise spot where your phone summoned it was in fact a car that was being dispatched by Uber. So that is the status of that case right now. There was a summary judgment that was granted. Uber has now, and I actually neglected to put this, I just realized I neglected to put this on here, but it just recently happened about a week ago that Uber has appealed that decision to the Superior Court of Fulton County. That has just been docketed and, will be obviously proceeding in the normal course up there. So we will have further developments on this next year, but those two cases are interesting evolution in the sales tax arena. Next, quickly, we have Southern Regional Medical Center versus Crittenden. This is a carryover from next year and really not a lot to report this year. That was a case where a for-profit hospital, there's a sales tax exemption for durable medical equipment, 488354. And what it says is the sale or use of any durable medical equipment, durable medical equipment is kind of what you think, prosthesis or wheelchair or something like that. That is sold or used pursuant to a prescription, or prosthetic device that is sold or used pursuant to a prescription. So, what you kind of automatically think of as a consumer, a patient who purchases something that his doctor prescribes for him, like, I have to get a wheelchair or a walker or something like that. It's prescribed, they purchase it, there's a tax exemption. The question here is, when a for-profit hospital buys those same items, are they entitled for the exemption? And the hospital in that case was arguing, well, we're using it, we're buying it pursuant to a prescription, and the department's position was, the exemption only applies, or the intent of the exemption was only to apply to natural persons to whom a prescription is issued. So in other words, the hospital's saying that, well, when these items are going to be used by a patient, they'll be used pursuant to a prescription. It's a question of perspective. All I can tell you about the Southeastern Regional cases, that's now been resolved. It was resolved this year, and it was dismissed in just last month, November of 2022. So we don't have any kind of published decision or precedent there. Just so you know, that technically, as far as legal precedent goes, is going to remain an open issue for the time being until something comes along next. Fundvestment. Fundvestment is another case that's a carryover that we had a little bit of development in the past year. Fundvestment was a COAM case, and the question there is, there's a sales tax exemption for gross revenues generated from all bona fide coin-operated amusement machines. And I don't know how familiar you all are with COAM, but kind of basically the structure is, regulatory-wise, it used to be different, but nowadays, there's a COAM master licensee who's kind of the person who oversees the COAM machines that are actually placed at locations. So you have a master licensee, and then he in turn controls location licensees. Location licensees are the actual locations where the machines are placed, which most of us will know them as like gas stations. And the master licensee pays a fee to the state. The location licensee pays a fee to the state. The location licensee does not pay sales taxes on the revenues generated from those machines. That they pay the fee instead. It used to be different, but now they pay the fee. And then the master licensee sometimes leases the machines to the location licensee. So the question posed in this case is, where the sales tax exemption says gross revenues generated from all bona fide COAMs, does that apply to gross revenues in the hands of the lessor of the machines? So in other words, you're not the person who's leasing them and actually, taking in the money from people who put the coins in there. That clearly is not taxable. The question is, you're the person who's leasing the machine to them. Are your gross revenues from the leases exempt from sales tax? Because, quite literally, gross revenues generated from a COAM machine could apply to that.
And Ron,
Yeah.
and this would be this, just so that everybody understands the model here. This is where it's not where the machines are sitting in a bar and somebody's putting coins into the machine. It's where the actual machines are being rented to the bar.
Exactly.
It's the rental of the tangible personal property, basically.
Exactly. It is exactly that.
And the exemption is for the money that goes into the machine, but apparently this taxpayer was arguing that this is for, the exemption extends to the money that goes to the lessor of the machines.
Exactly
Okay,
right.
all right,
Yeah.
okay.
And it's a question of perspective. It's kind of like the durable medical equipment case we just mentioned. It's the same thing. It's like gross revenues from whose perspective, right? Gross revenues from the gas station guy's perspective, or gross revenues from the person who's renting the machines to the gas station guy. And so that was the argument of fund investment. They said, look, there's no limiting language here. It doesn't say, gross revenues are gross revenues. The department's argument, which was, not bought by the tax tribunal, but was bought further down the line, was that, look, what it actually says is the revenues must be, and I'm kind of paraphrasing here. The exemption actually says revenues generated from COAMs which vend items or dispense entertainment or operated for entertainment, which are in commercial use and provided to the public. And so our position was that, if you read that language and construe it, harmoniously and construe it in accordance with its plain English kind of sense of the word, it means the revenues that are actually generated from operating the machine, on the operation end of the machine and the public facing side of the machine. That's what, this whole idea of plain language and the plain meaning of the statute. And of course, even that is a little bit of a question of perspective. One person's plain language is not the same as another. So the tax tribunal did not agree with that assessment. The tax tribunal said gross revenues are gross revenues, period. And we lost. We appealed to Fulton Superior Court. And in Fulton Superior Court, we won. The court sided with the department and said, when you read the entire definition from top to bottom, our read of that plain language is that it only means the machines in the hand of the location licensee. And what happened last year is that after the Superior Court sided with the department and a discretionary appeal was filed for and granted, the Court of Appeals affirmed the Superior Court in June of last year. And thus, as of right now, at least, that is now the law, that this exemption does not apply to lease revenues on these machines. The Court of Appeals essentially agreed with the Superior Court. It also noted there was a whole kind of sideshow in this about legislative intent and the structure of the COAM industry and that kind of thing. And what both or at least what the Court of Appeals said was, look, we don't want to get into that. We don't need to get into that. We can just ride with plain language here. There's no need for us to second guess the legislature or get into the history of COAM taxation, which, I think there was some COAM industry backing for this appeal. So there was a lot of resources put into it. And, the Court of Appeals said, I think they use that old maxim, we presume the legislature knows what it's doing. They say what they say and mean what they mean, or however it goes. So all of that stuff was kind of brushed aside, and the Court of Appeals basically said, no exemption for that. They did affirm on that basis, but they remanded back to the Superior Court on one kind of minor issue, which was that because of how it had developed in the tribunal, there had never been any fact finding on the lease payments. So the department's assessment, there's a question as to whether or not the department's assessment was correct based on the lease payments. And so the Court of Appeals remanded it back to do some fact finding on that. But in the meantime, the fund investment folks have applied for cert in the Supreme Court of Georgia. So in the past year, that application's been made. It's been fully briefed, and we are now awaiting a decision as to whether or not the Supreme Court is going to accept cert in the fund investment case. So for right now, that's our law. No sales tax exemption for COAM lease payments, but stay tuned in 2023. Next, we have CSX. So this is a new one for this year, and it's pretty significant, pretty interesting. I don't know how much all of you are aware of any of these issues. I certainly wasn't until getting involved in this, but these are cases that have been around for quite a long time. Basically, the question is, can the state of Georgia assess sales tax on diesel fuel purchased by railroads in Georgia? Pretty straightforward. And there have been refund claims filed for years. The basic claim in CSX is that Georgia sales and use tax statute violates the U.S. Constitution, and it does that. Violates federal law by discriminating against railroad companies. Basically, there's a federal statute called the Federal Railroad Revitalization and Regulatory Reform Act. It's called the 4R Act. And what the 4R Act says, and it's found at 49 USC 11501, what the 4R Act says is that any state and local taxes that discriminate against common carriers by railroad, basically if you tax the railroad in a way that you don't tax other common carriers, then that's violative of federal law and it's got to go. And Georgia's sales and use tax statute does not tax water carriers, interstate water carriers. So their fuel purchases are not taxable. Railroad diesel fuel purchases are taxable. And so in these cases, CSX has argued that the Georgia statute violates the 4R Act. Federal law always wins, supremacy. So those taxes have got to go. They've got to be refunded. As y'all can imagine, I can't give you specific figures, but as you can imagine, it's quite a bit of money. You're talking about a substantial amount of money over all the years of refund that CSX has paid taxes on their diesel fuel. So they've been filed at the tribunal since about 2015, and they've been stayed since about 2017 at the tribunal because there is some litigation in Alabama, and this issue has been litigated in Alabama quite vigorously for quite a long time, and it has fairly recently reached its endpoint. It actually took about 10 total years. That started in the U.S. District Court in Alabama. Basically, Alabama has a very similar sales tax scheme as Georgia for fuel. For purposes of our discussion here today, there aren't any real, material differences that would be worth talking about. So the railroads in Alabama, starting with, I think it was CSX, and then continuing with some of the smaller railroads, filed suit in district court there to basically get Alabama's tax, struck down, or to basically get a declaratory judgment that they had a right to a refund because their tax violated the 4R Act. It took about 10 years of litigation. It went up and down from the district court to the 11th Circuit to the U.S. Supreme Court multiple times. The first major development was in 2018 when the 11th Circuit ruled that, yes, the Alabama statute did in fact violate the 4R Act. Honestly, not a terribly shocking outcome. I mean, it is, it's easy to follow the logic. And the Georgia statute is similar enough that decision, especially since it came from the 11th Circuit, is probably going to have some play here. What happened after that in Alabama was the 11th Circuit remanded it back to the district court to enter a final judgment. A final judgment was entered in one case in 2019. Final judgments have now been entered in some of the smaller district court cases in 2021. So the litigation in Alabama is mostly concluded. However, nothing's ever, lawyers never say die. So very recently, November 10th of 2022, that's not even a month ago at this point, the city and county of Tuscaloosa have petitioned the 11th Circuit I honestly can't speak to the procedural posture, how this has been filed or what the standing is, but basically they've asked the 11th Circuit for another bite at the apple, arguing that they weren't able to participate in argument earlier. So they're basically trying to relitigate this whole thing. I don't know how successful that's going to be. I don't know how they're planning to do it, what their strategy is. I just know that is going on now, and that this thing is still alive in some minor way. So as far as the Georgia litigation goes, the tax tribunal litigation remains stayed until we are absolutely certain that every last shred of litigation is exhausted in Alabama. We're going to have to determine how to proceed with that, but it's certainly, the handwriting is becoming increasingly clear. Let's see, next we have a state operation assessment, the club executives case. This is the Safe Harbor Rachel's Law Act. That is an assessment that was passed by the legislature on adult entertainment establishments to fund the Safe Harbor Fund. Safe Harbor Fund is a state fund that's designed to combat sex trafficking of minors. And it provides, there's a committee or a commission that runs it, and they provide funding to a variety of causes that combat and mitigate the effects of sexual trafficking of minors. And so the act basically imposed a 1% gross receipts tax on adult-oriented businesses or adult entertainment establishments that serve alcohol. And the tax is 1% or at least $5,000 a year. This has been going on for a while. That law was passed in 2015 to take effect 2016. This litigation started in 2017, and a trade group of the clubs basically banded together and filed suit to have the law declared unconstitutional for a couple of reasons. The first is that they said nude dancing, which, adult entertainment establishments is defined in the statute, and it is defined in part as establishments that both serve alcohol and allow for nude dancing. And I won't go into all the details of the definitions. It'd take another hour, but basically, they're saying that nude dancing, as it's defined in the statute, is a protected activity under the First Amendment, which it basically is, and therefore the tax violates the First Amendment. Secondly, the initial lawsuit said that the statute was unconstitutionally vague because the definitions were not stringent enough and could be too broadly applied, et cetera. And there were a couple other minor claims involved in it as well. So of note, what's happened in this case is that in 2017, initially, we prevailed in a superior court trial concerning the constitutionality of the law. For the most part, they did hold that one of the terms it contained in the law was vague, but they upheld most of it. In Georgia, when a law is declared unconstitutional by a trial court, you have a right of direct appeal to the Supreme Court. So that's what's happened. This case was up at the Supreme Court of Georgia for a very long time. And it actually went up to the Supreme Court on July 8th of 2020. And it was there for 2 years. And in March of this year, March of 2022, the Supreme Court came back and they punted. They basically said they didn't address any of the merits of the case at all. What they said was that the case was styled Georgia Association of Club Executives, Inc. versus Lynn Riley. Lynn Riley was the commissioner of revenue at the time the lawsuits were filed in 2017. All of you that practice in the tax tribunal and in other kind of areas relating to tax, there is a concept in the law that when a revenue commissioner changes, they automatically get substituted into the lawsuit. Well, that is not the case in this particular kind of litigation. This was a constitutional claim. It was filed under the Sustainable Coast. There's a line of case law pre-2020 that governed how you would sue the state to have something declared unconstitutional. And basically you had to sue the state officer who was responsible for administering the statute. And there is no automatic substitution. So when the officer changes, you've got to ask the court to change the defendant, and they didn't do that. So as of the time the Supreme Court was looking at it in March of 20, or, over that 2-year period, Lynn Riley wasn't the commissioner anymore. They actually were 2 commissioners down the road. And so the Supreme Court just said, you know what? Got the wrong defendant, reversed, remanded with instructions to dismiss Lynn Riley. Thank you. Have a nice day. And that's where it was left. So what happened was, we all know where this case is headed and what needed to be done. There was no sense in dragging things out. So we got with the plaintiffs, and they refiled in Fulton Superior Court with the correct defendant, and the case started over again. We expedited the briefing. That briefing was done, and oral argument was conducted this past year. So basically now it is back in the hands of a trial court judge in Fulton County. It's actually a new judge, it's Judge Edwards, and she is going to decide the issues anew. There's some slight differences in the lawsuit from the first time around, but really nothing worth mentioning. It's still a First Amendment challenge. And like I said, we could talk about this one for a really long time, but just understand that the law is under constitutional challenge right now, that tax is under constitutional challenge. The various clubs are all, the department's working with them in terms of how they're either collecting the tax or allowing them to, protest it and hold the protest in abeyance while the litigation plays out. Floyd Healthcare Management versus Crittenden, that is another case that initiated in the tribunal that we covered last year. And that one asked the question, and I know we talked about the quality jobs tax credit. Charles mentioned it, I think among other folks prior to me. That case asked the question, can a nonprofit corporation, in this case Floyd Healthcare Management, they run Floyd Medical Center, can they claim the quality jobs tax credit for jobs that are, that do not generate taxable income? In other words, the hospital jobs that relate directly to the provision of healthcare, can those kind of jobs be quality jobs? And can those quality jobs give rise to the tax credit in the hands of a nonprofit that does not pay income taxes, at least as to its core mission? Now, Floyd Healthcare Management, like a lot of nonprofits, does generate some taxable income. They call it unrelated business income. It's the gift shop, the Starbucks, the cafeteria, whatever. But the question really was, if they're opening a hospital and they're creating 150, doctor, nurse, medical tech jobs, and they're generating, a certain amount of ostensible credit due to the creation of those jobs, can that credit be created, and can it be applied not only against their unrelated business income, but the way this credit is structured, to the extent it is in a greater amount than your tax liability, you can use it to offset your withholding. So, it basically, becomes, in a sense, becomes almost a refundable, there's no refundable credits in Georgia, but, becomes an almost cash payment back to the entity if you go beyond their tax liability. So this one started in the tax tribunal, and the real issue here was the statute is pretty straightforward. It says that the credit's available to any taxpayer, and taxpayer is defined quite simply as anyone who files a return or pays taxes. So the question was, well, are you a taxpayer if you file a return that's just an information return as opposed to an income tax return? And are you a taxpayer if you only pay taxes on your unrelated business income as opposed to, not paying taxes on your primary purpose? And then there was also an argument that related to the definition of quality jobs and whether or not the quality jobs had to be related to your unrelated business income, or they could just be any job. And in this case, the tax tribunal and then the Superior Court both sided with Floyd. The opinions were pretty straightforward, and they just, again, went right back to the old reliable plain language. And they said, the legislature said what it said and apparently meant what it meant, which is, files a return or pays taxes mean they're disjunctive. I mean, they file a return, it doesn't say they have to file an income tax return or any kind of return, just a return. And they do pay taxes. They pay taxes on their UBI. So they took that statement quite literally and held that they qualified. And the quality jobs argument also was, I think, given pretty succinct treatment. And there was nothing in the statutory definition of a quality job that said it had to relate to any particular kind of income. It was just defined by the kind of job it was and the kind of wage it pays. So it did not say it had to be related to a business activity that generates taxable income. So based upon the tribunal and then the court's reading of what they regard the plain text of the statute, the department did not prevail at either the tax tribunal or Superior Court level. There was an application for discretionary appeal that was made by the department this past year, but it was subsequently decided to withdraw that. So as of right now, that's the outcome in Floyd. We have the highest level of opinion is the Superior Court, so we don't have any, binding precedential opinion on it yet. This could come up again in the future. Obviously, as you all can surely imagine, Floyd Healthcare Management is not the only nonprofit healthcare entity in the state. And, this could come up in other contexts, theoretically in the future. Comcast, I won't dwell on too much because there's not a whole lot we can say about Comcast at this point. They have filed a petition to the tax tribunal. It's quite a bunch of issues, but it related to film tax credits, gains on sales, disallowance of interest expenses, related party interest, and net operating losses. Basically, the thing that kind of ties everything Comcast together is they are, as you all I'm sure know, a large and sophisticated entity with many operating divisions, and a lot of this relates to allocation of gains and losses, allocation of interest expenses, allocation of intercompany concepts between company entities. And there's not a whole lot more I can tell you about it right now because it has not progressed very far in the tribunal, other than the parties are talking and engaging, and we will have to wait and see how that one develops next year. Richard, how am I doing on time?
You've got a couple more minutes if you want to cover the last two real quickly.
Yep. All right. The last one I will cover real quickly. This Great Wolf Lodge. That is a question about lost and lost refunding under the Georgia Tourism Development Act. Basically, that act allows development project to get refunds of sales taxes. The key requirement here is that the refund has to be pursuant to an agreement with obviously the taxing authorities, the localities, the counties, and it speaks of there has to be a resolution of the county governing body setting that up. And what happened in Great Wolf is that Great Wolf struck a deal with Troup County and the city of LaGrange. And if y'all know Great Wolf Lodge, it's like a water park hotel out there in Troup County. They struck a deal with them that was initially set forth in an MOU, a memorandum of understanding. And the MOU mentioned lost and splost, two different kinds of sales, local sales taxes.
Yeah. Why don't we tell lost local option sales tax, splost special purpose local option sales tax?
Yes.
Just two different 1% county taxes.
Exactly. So yeah, two different kinds of local option sales taxes allowed under the law. It mentioned both of them in the MOU, which is not really the binding deal. It's kind of, hey, here's our general understanding. But what happened is when the county commissioners passed the resolution that actually talked about, how this was going to work, they only mentioned the lost. They did not mention the splost. I don't know what happened. I think that's between Great Wolf and the county, but they only mentioned the lost. And the splost was not only not mentioned in the resolution, but it was not mentioned when they renewed their splost in that resolution. It was not mentioned in the voter ballot to affirm the splost renewal for the coming period. It just kind of fell off the radar, basically. So what happened was Great Wolf wanted a refund of both, and they pointed to the MOU and they said, this was our deal. We'd like a refund. And the tax tribunal said no. They granted summary judgment. They said the statute says what it says. There's got to be an enabling resolution. It's just not there. So we've got to follow that by letter. And even though you may feel like this was the basis of your deal, and even though you may feel like, this was your understanding of how it was supposed to be, we did not check every box and dot every I here, and the county did not include that in the resolution. So, you only get your lost, you do not get your splost back. Last one, Lumpkin versus State of Georgia and City of Dahlonega. This is a really fascinating one, but I'll go through it real quick. It just came up. This, again, is lost, local option sales tax, and specifically Lumpkin County and the City of Dahlonega. The way those work, for those of you who may not be familiar, is that they run for a certain period of time, and the Department of Revenue basically administers and collects those sales taxes and then distributes them to the counties and the cities that participate in accordance with a certificate that they are provided by those localities that presumably reflects their agreement on how it's going to be split. And they have to be filed, the certificate has to be filed, and the law provides that every periodic amount of time they need to be renegotiated. If they can't agree, the localities have to go to a non-binding mediation to try to reach agreement. But at the end of the day, they need to provide the department with an agreed upon certificate as to how things need to be allocated. In this case, according to the county's lawsuit now, I'm going by their petition because this is so new, that's really all we've got right now. They started to negotiate with the city in June of this year. They made them an offer to start the negotiations. We'll split it 75-25. And then what the county did, which you could argue maybe they shouldn't have done, is they sent the form to the city and they signed it. And they said 75-25 signed Lumpkin County. And then there was a blank signature line for the city. The county then says the city got back to them and said, no, we don't want 75-25. We got your certificate. We don't want that. We want to have a mediation. And what happened then, though, was that for whatever reasons, and they can probably fight about this, the mediation didn't happen. The city signed the certificate and sent it to the Department of Revenue. I mean, there's intervening events there. I don't know what they are. There's some resolutions and some other things, but the end result is the Department of Revenue got the certificate in October of this year, when there was a due date for those things. The renewal, this new collection was going to start January 1st of 2023, and we got the certificate. And right after we got it, the county contacted the Department of Revenue and said, no, that certificate's no good. We didn't agree. You got to understand, there's a whole long litany of stuff that happened, and this is not a real certificate. It's not a real agreement. You can't honor it. So the department had to decide what to do. The department decided we have a facially valid certificate. As much as you may want us to adjudicate the dispute between the county and the city as to whether or not it's a real agreement, we can't do that because there is nothing in the statute that allows us to. The statute says nothing about the Department of Revenue being empowered to decide disputes between cities and counties as to whether or not a certificate is real or not. This one complies with all the requirements. We are going to have to go ahead and start using it in January 1st. So the county filed several lawsuits. They filed one in Fulton County asking for the certificate to be invalidated, and one up in Lumpkin County against the city, trying to unwind it and also force the city into mediation. The upshot of this is it's brand new, but we are looking at getting the department has no position. We're fine with whatever the court decides. We just told them we can't decide it. You have to figure out, you got to get a judge to tell us whether the certificate is, valid or not, because under the law, there is no provision that will allow us to say it's invalid.
So you interpleaded the certificate.
Kind of, yeah. I mean, what we basically said is that, we're going to move looks like we're going to get all the lawsuits consolidated in Fulton, and we're going to kind of sit to the side, let the city and county fight it out. And hopefully they're going to be able to do this before the end of the year. Because what everybody agrees is the best thing for the public and the taxpayers is let's get this resolved. Let's
Sooner
get a
than later.
certificate in place before January 1st, so that Lumpkin County, Georgia can start collecting some sales taxes.
Right.
And isn't without them, because that's what nobody wants.
Right.
So that's
Ron-
where we're at on that one.
Ron, excellent job. We really appreciate it. Very, very well done. Thank you so much.
Yes.
And we will move now from Ron to a final little note on collections issues. Charles Elrod is stepping back in again, and he'll give us an update on collections issues. And I'll tag in Charles right now.
Richard, can you hear me?
Yes.
All right, everybody, we are under 10, T-minus 10. I will not even take up the full 10 minutes. I know everybody's ready to get out of here on this nasty afternoon. So I picked a short little topic for collections today. Before I get to the short topic, the shortest of all short backgrounds on collections. Georgia, like all other states over the past 50 years, figured out that voluntary compliance was the best way to maximize revenue collection, as opposed to going through, old-fashioned just collect, be adverse as possible, file suit, get as many liens as possible, and that doesn't work. All states have realized that it's much more efficient. Send out letters, make phone calls, put people on payment plans, and work with people to maximize the state coffers. With that being said, other states rolled out a program starting about 5 or 10 years ago. They all use the same acronym. It's called FIDM, Financial Institution Data Matching. And we actually already have it in the state of Georgia, because in 2018, the legislature put FIDM, Financial Institution Data Matching, in place in order for child support. Those who are behind on their child support payments, they could have their bank accounts garnished and in order to pay child support to the intended recipient. So skip ahead 5 years, and the legislature thought, you know what, I guess if we can do it for child support and DHS, then there's no reason why we can't assist DOR in collections if we don't roll out a similar program. So what is it? It is basically the statute, which is 48263. Sorry, I probably should have said that up front, but I moved fast. 48263 allows the state to reach out to financial institutions and see if there's a data match that matches up with those particular delinquent taxpayers being those taxpayers for which state tax executions exist. And then it is the financial institutions will be required to hand over the taxpayers for which matches exist. So at the end of the day, revenue has access to bank account. It kind of knows where certain bank accounts for certain taxpayers may be through information provided through us, whether it's through an online filing of taxes or with your tax returns, your income tax return every year. Oftentimes there's financial the institution data included in that. So we have avenues to explore, but this really opens it up. And the FIDM program will, with much less effort, allow us to hopefully recover some more delinquent taxes. It's a new program. The rollout is, I think, been less than 6 months. At this point, it's my understanding that 71% of the financial institutions in the state of Georgia have signed up. We are we're learning a few kinks. We're discovering a few kinks along the way, especially as it relates to the agreement that we have that We're hoping that everybody will sign, that the Georgia Bankers Association signed off on as well, but I'm not going to get deep into that. I think for now, I just want to tell you everybody what it is. And that hopefully in the next year, we will have all banks signed up, and to the extent that we need to hone in on any particularities, we may issue a regulation in 2023. That's your FIDM, everybody.
There's a question. Do you have any idea how much of this the department is doing right now?
Well, I'll leave it at this, Richard, that, I mean, if we already have 70%, 71% of the banks signed up,
Yeah.
I mean, and that's in a pretty short amount of time period. I don't know the answer, but I think I could, it wouldn't be too dangerous for me to say. It's not that hard to allocate resources for this with the return that may be involved. At least that's what I think the theory is when when the legislature looks at the situation, and I don't have any reason to contradict that theory.
Great. Well, Charles, thank you very much. And for everyone, that ends our 2022 liaison meeting. On behalf of Mace, Commissioner O'Connell, all the speakers, presenters, thank you for attending, and have a nice holiday.
Thank you, Richard.
Thank you, Richard.
Ladies and gentlemen, this does conclude today's meeting. Thank you for joining and have a great afternoon.